Can you believe this? 17% of millennials, yeah, you know those hypocrites who like to shut down free speech in universities but claim they're against fascism? Yeah, those people. Millennials consider gold their preferred investment, and 30% prefer cash, and only 13% prefer the stock market as their preferred investment. Are you people insane? But here's everything you need to know about gold. This right here is why gold should not be your preferred investment. This ugly chart. Sometime after we went off the gold standard, we had this big bubble when gold went from over $100 to over $800. Then it was 22 years of going down and leveling out. And from peak to bottom, you lost maybe 2/3 of your gold's value. This is insane. What kind of investment is this? Who has the patience to wait around for 22 years? Not me. And so finally, from around 2001 to 2012, gold went up and we had another bubble. But now it's been 6.5 years of decline and floundering. I don't know. Is this going to turn out to be yet another 22-year bear market? And so we've got another 15.5 years to wait before we see the next move upward for gold? So as the stock market keeps hitting all-time highs, the people who sell gold, Peter Schiff, Mike Maloney, the gold commercials, they're whipping up all this fear, usually about an impending stock market crash. They'll say, oh, the stock market has been going up for 9 years. This can't continue. By the way, first of all, it's been said stock market bull runs don't die of old age. They usually die from something else, like the downfall of a credit cycle or the central bank tightening interest rates too much too fast when they shouldn't have, something else. So if you think that you can predict the next stock market crash just because it's gone up for 9 years, you might want to think again. You might want to look at 1982 to 2000. Some analysts are saying that this could just be the first leg of the bull market. The 80s and 90s bull run lasted about 18 years. Also, look at the crash of 87 when stocks dropped 33%. If you were loaded up on stocks and had at least been psychic enough to get out of the market 8 or 9 months before the crash, and had enough psychic ability to get back in somewhere around in here, it was basically a wash. You basically paid capital gains taxes prematurely and probably put yourself into a higher tax bracket. So if you're trying to time a stock market crash by loading up on gold, good luck. Especially if you're a diversified investor who owns bonds. With a 50-50 mix, you only lost about 7% from 2001 to 2002. Or in 2008, you only lost about 8%. So you don't have much to worry about in the first place if you're stock bond diversified. But if you are loaded up on stocks, look at Alan Greenspan's irrational exuberance speech in late 1996. The Federal Reserve chairman was saying, hey, the stock market is overvalued, but yet the S&P proceeded to go up another 100% over the next 4 years. If that happened now, that would take us to about Dow 50,000. Some of the best gains have come at the tail ends of bull markets. But so these guys who sell gold love to be suggestive and whip up hysteria. Always remember, the way to sell something to somebody is to scare them. And my favorite phrase that they use is a hedge against inflation. And the operative word is a hedge, because gold is just one of many hedges against inflation, if we have inflation. But so are other asset classes such as oil, natural gas, farmland, and to a lesser degree, commercial real estate. Even stocks can be a hedge against inflation. Any investment that keeps pace with or does better than the rate of inflation is a hedge against inflation. Here's a chart showing you the average rate of inflation by year, along with how the S&P 500 index did for that year. So, I don't know, you decide. Stocks have historically been the best performing asset class, so can you identify a trend here that would help you predict when to abandon stocks? I'm not going to say I can. What we can all see is that stocks and bonds are a whole lot more consistent than gold. Here's a quote from Augusta Precious Metals. The crash is coming. You can fight it not with stocks and bonds, but with precious metals. Number one, How do they know that a major crash is coming soon? And number two, if we look at past performance, you sure can fight stock market crashes with bonds. And if you're diversified, what crash are they talking about? I don't consider 6 or 8% a crash. Another catchphrase I hear is, stocks are just paper assets. The prices of stocks may be numbers on a piece of paper that your brokerage sends you once a month, but those prices represent real companies with value that generate income from established customers that they have built over the years. It's not a piece of paper that you own. So yeah, the values of companies are based on perception, but so is the value of gold. It's all based on people's perception. Anyway, if you do decide to own gold, then I would buy an ETF like GLD instead of physical gold. This way you don't have to deal with the hassle and risk of getting robbed storing physical gold or transporting that gold to and from the dealer. And you don't have the risk of buying counterfeit gold. It's rare, but it has happened to dealers. And when you buy physical gold, you typically pay about a 5 to 6% commission. Also consider this, GLD has an expense ratio of 0.4%, so it's going to take you 15 years of holding that gold ETF just to break even on that 6% that you would have otherwise paid for physical gold. And so if you're one of the stock market doom and gloomers, most of you guys seem to think that a big stock market crash is coming soon, not 15 years from now. So if you're a shorter term gold investor, save yourself on dealer commissions, the risk of theft, and the hassle of driving that gold around. But if you do decide to buy physical gold, do not buy numismatic coins or collectible coins. Dealers charge bigger markups on these coins. Also, don't buy proof coins. Instead, just buy plain old gold bullion, such as 1 ounce American Eagles. And you really should buy in person at the most reputable dealer near you, not through the mail. You want to be able to have that gold tested right in front of you. Also, one more thing to think about, gold is taxed at the higher collectibles tax rate, usually up to 28%, whether you buy physical gold or ETF gold.